Hello and welcome to another episode of Darwin Investors. I'm making a rare midweek video because I feel like I have a lot of good news to share. One, GGPI had a really good up day, and despite the fact this was a down day. And then two, I want to show people why down days don't really bother me that much, because I can show you how I'm making money on these down days or how I generate future revenue. So let me go ahead and share my screen and we'll get right into GGPI. So GGPI stock, you can see on a day where the indices were all blood red, went up 52 cents or 4.87% today. If you look over the past month, we've had a very volatile market. However, GGPI does not move. GGPI is the SPAC that's going to bring Polestar public. Why doesn't Polestar move much? Well, Polestar doesn't move much because they're hitting their numbers. This car is pulling through. They're sponsored by Volvo, and they are hitting their target. So Polestar hits their 2021 sales target of 29,000 vehicles, up 185% year on year. And so despite the market chaos, as we've already demonstrated, Polestar, the SPAC, still has positives even in a rough market. It doesn't fall because this stock, this car company, Polestar, is commercially proven. Polestar delivered more than 10,000 vehicles even in pandemic-stricken 2020. Its 2021 full-year deliveries are up sharply. The company will have brought in more than $1.6 billion in full-year revenues in 2021. This means that Polestar is already a demonstrated success in terms of attracting a meaningful customer base. And so if you compare them to people like Nikola, Arrival, Faraday, and Canoo, they're well ahead of them. And even if you can compare them to other startup rivals like Lucid and Rivian, they're ahead of them. Polestar, by contrast, already has a sound operational business that has sold an impressive number of cars at a workable price point. There's proof that the business model is workable. And so they have a price point of $45,900 on average. So this is actually an affordable EV. This isn't your $150,000 car, the Polestar 2. And Polestar is a platform company. Another attractive feature to Polestar is that it's going for a full range of electric vehicles. The Polestar 1 is a premium performance hybrid, and the Polestar 2 offers 100% electric experience with an impressive 336-mile range. That would be for the long-range vehicle. But this is the part that's very exciting here. Coming up, Polestar plans to launch one new vehicle each year. This year will bring a luxury aero SUV, think Porsche Cayenne. Next year, Polestar will unveil a sport SUV, think the Porsche Macan. And in 2024, the Polestar 5, a GT 4-door, will launch. So the Polestar 5 would be, think of like the Porsche Panamera or perhaps the Tesla Model S. Overall, Polestar envisions getting to nearly 300,000 vehicles sold annually by the end of 2025. Now, this is interesting. So if a company like Nikola or Canoo say they will make 300,000 vehicles a year, we take that with a grain of salt. Those companies failed to meet the first steps of their initial business plan, inspiring little confidence towards reaching their additional goals. Polestar, however, already has built two successful models and generated a ton of momentum. It's far more credible hearing them lay out a measured growth plan, including rolling out one new vehicle type per year. Again, these guys have a track record because they are an arm of Volvo. Volvo, and the partnership with Volvo is allowing them to hit their marks. So Polestar's backers also inspire confidence. Polestar originally came about as part of Volvo and still benefits from its partnerships. Volvo offers global reach, marketing, and distribution. In Polestar's investor presentation, it notes that only it and Tesla have true international brands across multiple EV types. Other players are limited to certain regions or vehicle types. Polestar, by contrast, has the chance to truly rival Tesla on a global scale. They're getting it done. If you go down here to the verdict, you've got to be, they think here, you've got to be something of a gunslinger to be aggressively buying stocks here. And I guess I'm an aggressive gunslinger because I've got quite a bit of GGPI because hey, it was 11 bucks. So I went ahead and got some, and I believe in this company. I believe in the deliveries, and I like the price, and I'm a believer, and so I'm just going to hold it and see what happens. And that's doubly true for shareholders of unprofitable companies that have yet to prove out their business model. This is where Polestar shines, however. It has already demonstrated significant commercial success with its first vehicles. Polestar has solid backers and a credible story. This is not just another fly-by-night EV SPAC with a nice prototype or two. There's a real team here and a commitment to making a serious run at large-scale electric vehicle production. So why was it up today? Well, Polestar is actually going to have a Super Bowl commercial. They're having an ad during the Super Bowl. And so that Super Bowl ad and giving it a world spotlight, if you will, on the Polestar 2 is created some excitement. So investors in Gore's Guggenheim stock are anxiously awaiting February 13th, the day of Super Bowl LVI, whatever number that is. As a refresher, Gore's Guggenheim plans on merging with electric vehicle maker Polestar via a SPAC in the first half of this year. So the merger is happening in the first half of 2022. Polestar recently released a 15-second Super Bowl teaser ad that details the 2022 Polestar 2. Now, I've seen it. The reason why I got interested in Polestar was I was in downtown. I was walking around Manhattan, and my wife and I, we went past a Polestar dealership, and it's an eye opener. This is a pretty car. I can see they're not going to have a lot of trouble selling a $45,900 Polestar EV, at least not the one I saw. So they have the Super Bowl ad, and that would be the reason for the bump in Polestar on a very bad day. Let me go ahead and show you the type of day that we had today, and this would make it even better. So let's see, the S&P was actually down 83 points today, and on a day when the S&P was down 83 points, GGPI was up 4.87% on the Super Bowl ad news. Now, in other related topics that I want to get into, and the reason why I'm putting this video out today, because this is something I'm going to do. It's not financial advice. I'm not telling other people to do, but I'm saying that I have done it. So one thing I did today was earlier today, I exited my AMD position. Now, AMD is something we'll revisit later. I'm not done with you yet, AMD, but I want to show you what I've done here recently with AMD. And I'll show you why I exited this position and what I have coming up in its stead. So here I got into AMD on the 1st of February, and it looks like I sold a put with a $105 strike. I got $319 for it. It expires what would be next week. I sold it for $319. I bought that back for $95. I bought 100 shares at $114. I sold them at $119.50. Then I bought more at $121 and sold those at $128, making a grand total profit in a week and a half of what $1,433 on AMD. So I was doing quite well on AMD, but I jumped from where I see the opportunity. And the opportunity that I see coming up this week is going to be with advanced auto parts. And let me show you what I have, what I see with that. So I love this part of earnings season because what happens is you can start comparing companies within an industry to another company that just like it that recently reported. And O'Reilly Auto Parts reported yesterday, and they reported a 26.95% beat on EPS and a 6% beat on revenue. And on a miserable day, they were up $18.23 a share, or 2.85%. So what that did was it made a re-rate of Advanced Auto Parts stock. Advanced Auto Part, in fact, the most accurate estimate for the current quarter is currently at $1.98 per share for Advanced Auto, compared to the broader Zacks consensus estimate of $1.95 a share. This suggests that analysts have very recently bumped up their estimates for AAP, given the stock a Zacks earning ESP of 1.84% into earnings season. So that's important because analysts raising estimates right before earnings with the most up-to-date information possible is a pretty good indicator of some favorable trends underneath the surface for Advanced Auto Parts. And so when you go over here to Earnings Whispers, you look, they report on Monday, February 14th. And we go over here to they're expecting at Earnings Whisper $2.11. Now remember, it was $1.95, bumped up to $1.98, and now Earnings Whispers is expecting $2.11. So let's look at this chart. Now this is a thing of beauty, and that's one of the reasons why I like some of these bear markets, you know, because what's going to happen is I can get in to Advanced Auto right here near the bottom. I think it's sitting at $223 today. Well, they have an area of support at about 220, and they have an area of resistance at about 240. So what that means is that I can sell a put clear down here at 210. I can buy the shares at 220, and I can sell a covered call at 240. So let me show you what I've done. So when I go over here and I look at Advanced Auto, what I did today was I turned around and I bought Advanced Auto Parts for $223.98 a share. And then I sold a put that expires next Friday, a $210 strike for $299.35. Now, what I'm hoping happens is that Advanced Auto Parts goes up to like $235, $236. And I'll be able to basically get about $1,200 out of this, plus this 300 would be 1,500, plus my covered call, which I'm hoping to get. Well, I may not do a covered call. I'm probably going to do a 1% trailing stop on them. So I'm going to go ahead and close out my put and then do a 1% trailing stop on Advanced Auto after they report. Because as soon as I'm done with this trade, then I'm going to go back into my AMD trade because NVIDIA reports on Wednesday, and I expect that they're going to get a bounce. That AMD is going to get a bounce at the same time that NVIDIA gets a bounce after their earnings. So I'm basically going to sell a put on Advanced Auto. I have the shares already. And then I'm going to, after earnings, set a 1% trailing stop on Advanced Auto because I expect them to be up, sell out of Advanced Auto, and then move that money into AMD again. And I'll do so by selling another put on AMD and then buying those shares. And so that's my plan for this week coming up. So I'm loving GGPI, I'm loving Advanced Auto, and I'm gonna play AMD as soon as I'm done with Advanced Auto. Now, why do I like these bear markets? Well, the reason why is because I buy really good stocks and they'll eventually come back. And so what this allows me is that I'll eventually get all of that money back someday. It may be a year, but I'll eventually get it back. But when the stock is going down, you can sell puts for a higher premium. When the stocks are going down, you can also sell covered calls and make money that way. When the stocks are going up, I can't really sell covered calls because I'm going to get, basically have to buy those covered calls back or lose my shares. And then also when the stock market is going up, the puts that I sell don't get any premium. Plus, I'm not able to sell them at a really good resistance point. So what I'm saying is that I capitalize on these down markets and I'm able to generate some cash. And so when this thing does eventually turn around, I banked all this cash and then those stocks will go back up to where they belong. And so I do it as it's going along. I do it through earnings. So I'm sort of like falling out of a money tree. And as I'm falling down, I'm grabbing cash on the way down. And eventually I'll be able to climb back up that tree again, but I'm grabbing all this cash and this cash is mine forever. And so then I go ahead and invest in something else. And I look at it as another opportunity. And then eventually I'll be able to go back up that tree again. And so that's the way I'm playing it right now. I'm going to grab cash on Advanced Auto, and then I'm going to grab cash on AMD. And those are essentially cash positions. Even though they're shares that I own, They are cash positions to me. I don't look at them as stock that I'm gonna hold forever. I look at it as stock that is essentially filling the position of a cash position for me. I generally am always in. Like when I play the market, my cash position is in shares that I believe have some upside, because I'm going to try and get some money out of dividends. I'm going to try and get some money out of covered calls, and I'm going to try and get some money out of share appreciation on stocks that are down for now and stocks that I expect to come back in the future. So if you got anything out of this video, please like, subscribe, and hit that little notification bell. I just had to pump out a video on this Thursday night because I think there's a lot of money to be made here in the next, like say, 4 trading days. Until next time, we'll see you then.